So this is the Loan Doctor podcast, and I am the Loan Doctor, where we turn home buyers into homeowners. And I'm with my good friend Noah, who is a financial planner. When you have a client and you're advising them in terms of what type of investments to purchase, where does real estate fit on that list?
People invest in what they know. So probably not surprising someone in your world, you deal with a lot of real estate investors, can be very long real estate, as the expression goes. So they can have a very significant portion of their net worth tied up in their real estate investments.
A lot of times when people are looking to maybe tap into their equity in their home for certain reasons, they come to you when it's too late because for them it's the last resort. And then instead of us coming and developing a plan that would have put them in a better situation, they're coming to us when it's almost too late for us to help them.
I would find out family history, I would find out balance sheet, and spend is the big one. We like to say that the most expensive day of the week is a Saturday. Well, in retirement, every day is a Saturday.
In a person's financial plan, how does insurance and annuities sort of fit into that?
About 98% of term insurance policies will expire, meaning they won't pay out, meaning 98% of the time the person doesn't die and their family, their beneficiary rather, does not get the payout.
How many clients do you guys typically work with at a time in terms of managing their portfolio so somebody knows that they're getting that personal attention?
My team works with about 300 families right now. We have about 2,000 accounts total across our 7 people or 5 advisors.
When the Fed makes an announcement about rate cuts, immediately after, the inverse happens. Rates are actually going to tick up.
Like everyone else, I read what I read, I see what I see. I don't want to get left behind.
Ask you a little bit about crypto.
I don't like it. I don't like it as a store of value. I do like it as a hedge. I do like it as an exposure.
When somebody buys a house, what's the first thing they should do when they're ready to start going through that financial plan?
We like to say that when I put together a financial plan, it's a living, breathing document. Things are always going to be changing. I will put together a financial plan that shows 25 years from now, you have an 87% chance of success. I don't think my generation will create wealth in equity the same way that previous generation has.
So you have somebody who comes to us and they're either not ready credit-wise, they're not ready down payment-wise, they're not ready with stability of income-wise. And so what we do is we just kind of set up their roadmap. And then what we're going to do is we're going to follow up, kind of like your mortgage personal trainer. And we're going to follow up and say, hey, how are we doing on these benchmarks? So this is the Loan Doctor podcast, and I am the Loan Doctor, where we turn home buyers into homeowners. And I'm with my good friend Noah, who is a financial planner. And we're going to talk about some of the things that Noah incorporates into his business as it pertains to real estate and even as it doesn't pertain to real estate. So let me start by asking you right away, when you have a client and you're advising them in terms of what type of investments to purchase or to acquire, where does real estate fit on that list?
Rich, first, thanks for having me. It's a pleasure to be a guest on the Loan Doctor podcast. I have done a lot of work with the Loan Doctor. I appreciate all that you do diagnosing my clients and their families and their friends and their real estate needs. Where does real estate fit in a financial plan? Oftentimes when someone comes to me, people invest in what they know. So probably not surprising someone in your world, you deal with a lot of real estate investors, can be very long real estate, as the expression goes. So they can have a very significant portion of their net worth tied up in their real estate investments. That's okay. A lot of people like knowing what they own. What it all comes back to is their risk tolerance and their liquidity needs. Those are the 2 things that myself as a financial advisor depend on for all investments, their liquidity needs and their risk tolerance. So what do I mean by that? Their liquidity needs, Rich, you help people finance the acquisition of properties as well as selling. Would you consider real estate something that can be sold immediately or on an open exchange within a day?
Yeah, no, real estate is not liquid. That's the whole idea. Yeah.
Right. So when it comes to risk tolerance, same thing. Usually I'll go through a diagnostic with a client. Can they take the pain of the roller coaster, so to speak? If they were to look at the S&P and see it down 10% one day, is that something they can stomach? Because risk equals reward. So where does real estate fit in terms of a person's financial plan? You're going to hate me, but like many doctors, I would have to diagnose that person. It depends for every person's financial plan. I would say that if I'm going to use broad strokes, big broad strokes, that I would open up my financial planning textbook. Like nowadays, they say about 2% of your overall net worth should be in cryptocurrencies. That didn't exist back in the
Wow.
day.
Okay.
They say somewhere between 18 to 25% of your net worth should be in real estate. For most of America, that is the home that they live in. That is
Okay.
that is their home equity attributed to their net worth. And so I don't want to go too deep down the tangent. It's a really great question, and it's got so many nuanced answers. And you know, I can talk your ear off. But is that fair to say? Where does real estate fit within someone's financial plan?
No, that's good. I think we talk about in the mortgage business, we have all these if-then moments, and everybody's financial puzzle is a little bit unique. So having that kind of answer just sort of makes sense, right? Is everybody's puzzle is going to be a little bit different. So how real estate fits in somebody's portfolio is going to vary based on their other characteristics that you were discussing.
Right. And if you know what you own, I know business owners that they don't have a dollar in the stock market. They invest everything they have back into their business. To you and I, that might seem incredibly risky, but to them who are in the weeds of it every single day, they know they can't create a better ROI maybe anywhere else. Who might argue with that? So knowing what you own comes back to a lot of usually those real estate investors.
Do most of your clients, when they're coming to you, do they already own their first home, or are they in that spot where they're getting ready to acquire their first home?
Yeah, great question. I would say my group works with a lot of aspiring professionals as well as a lot of retiring and successful individuals. So oftentimes we will be dealing with a family that are just starting out. So they need to do basic planning like life insurance. They need to do basic set up a 529 or college savings plan. And we'll often counsel them on the best ways to prepare to buy a home or to start saving for a home. I would say that to answer your question in a backhanded way, my clients often come to me too late when they're planning to buy a home. I wish they had let me in on the plan sooner. I've had clients that think this is my financial advisor. He gets paid when he has more money under his management. I'm not going to tell him that I have plans to move the money away. Well, I could have really helped in a better scenario, set you up for success. And just, if I may, just go maybe a minute deeper into that. When clients come to me, for example, Rich, a couple might come to you and they're sitting on cash, right? Because they know that over the next 6 months, the stock market's too risky. We can't do any investing.
Right.
We don't want to buy a CD either for the next 6 months because that's going to be lockup. What if I actually need the money in the next 6 months? I don't want to pay a penalty. Well, I've helped clients with cash management, treasuries, bond ladders. And for the layman's, what that means is getting yourself interest in small increments with money coming due over time. So it would mean that overall on that cash, you're getting, I'll make up a number, 3%, 4% in line with CD or money market rates. And it is always becoming available to you. So the plan would be to set up what they call a ladder between now and the home purchase. Money will be coming due every 3 months, 6 months, a year. So liquidity is never a concern, going back to the liquidity conversation. And there's no risk because these are guaranteed investments, guaranteed by the debt holders. Usually a treasury would be the U.S. government, so the safest entity that you can find. So back to your question, when do people come to me? Oftentimes too late. I wish that they would come to me sooner and let me in on how I can best plan for their home acquisition. That answer your question?
Yeah, no, it did. I think it sort of parallels something that happens in the finance space.
Yeah.
A lot of times when people are looking to maybe tap into their equity in their home for certain reasons, they come to you when it's too late because for them it's the last resort. And then instead of us coming and developing a plan that would have put them in a better situation, they're coming to us when it's almost too late for us to help them.
Yeah.
I had a client the other day that was in an unfortunate situation where had she come to me 6 months ago, we'd have saved her house, we'd have cleaned up her debt, and as it was, she's got to sell her house. The good news is she's going to start over, she's going to sell her house, buy something new, and kind of get a fresh start, so that part's okay.
Interesting.
So in lending,
Yeah.
one of the things that we have when we're giving somebody a loan, we're looking at the 4 C's, right? Cash flow, collateral, capital, and credit.
Okay.
When you're giving investment advice, do you have what is it that you're looking at from the person who's coming to you, from their profile, that says, okay, here's how we're going to attack this problem?
Yeah. So so much of what I do is so nuanced. So like going back to how I'm helping people, right, when they're trying to finance an acquisition, it's very different if someone's coming to me and they're just starting out and it's their first home versus, I have the 68-year-old that has a property and has a large investment portfolio with me. We're probably looping you into the conversation, Rich, and it's a little bit different than that family starting out. We're talking where are margin rates right now? Can we do a HELOC? He has existing balance sheet assets to borrow against. There's leverage there. So back to, I hate that my answer is often so nuanced, but back to what is something that I'm looking at? It's very, very specific to where the person is in life. I have really 3 or 4 main buckets of financial plan that people are coming to me to achieve. The biggest is, Noah, I want to retire. I have this pool of capital. I don't know if it's enough based on life expectancy, based on spend. Can you do some of those calculations for me, some cash flows? And so in that scenario, Rich, I would often need risk tolerance. You're going to hear me say that one a lot. I would find out family history. I would find out balance sheet, and spend is the big one. So I often will have my clients complete a budget sheet. Now, I don't make my clients live on a budget. Why would anyone hire me? Just so I can put them on a budget? No, but oftentimes for retirement planning, we like to say that the most expensive day of the week is a Saturday. Well, in retirement, every day is a Saturday. So if we can get an idea of where your spending is today and extrapolate it out with taxes and inflation, that's the best bogey. That's the best jumping off point that we can go for. So that's one of the big data points I'll collect is a budget. Some people will say, my kids are going to be out of the house. I'm going to sell the home. Everything's going to be lower. That's fine. You can tell me that, but then I would push back against you. 10 years ago, did you have Disney Plus and Hulu and Netflix and Amazon Prime? And things consistently change. Did you have,
Sure.
So there's always going to be expenses that you can't account for. So we like to, again, life is usually not getting cheaper. Usually lifestyle will creep, as they call it. Lifestyle creep will expand. So in that scenario, spend is really, really important, the bedrock.
Now, how does in a person's financial plan, how does insurance and annuities sort of fit into that?
Yeah, insurance and annuities are important. They are, in terms of a financial plan, they're the bedrock. So it's really cool to talk with my clients about tax loss harvesting strategies and how to achieve the most return possible.
Yeah, could you do me a favor? Just keep this to English because I'm losing you.
Right. So it's often like people want to talk about the offense of financial planning, investing and making money. But the backbone of financial planning really is in insurance and annuities, protective products that will guarantee you against the worst case scenarios. Because so much of financial planning is protecting people from themselves. Everybody is a Monday morning quarterback. Before they hire me, so many people are just going to Google what the S&P 500 did last year, and that's fine, but you were in cash all last year. You weren't in the S&P 500 all last year, so you're not necessarily comparing me against just what's out there. We are fighting against human nature, and insurance products do that. And I'll give you an example. We actually hope that none of these insurance products actually work. And I'm sure I'm not telling you anything you don't already know. But term insurance, for example, super important. All of my clients, I want to have term insurance. It is a cash cow for insurance companies. I make basically nothing on it. It is, however, super important in a family's lifestyle. About 98% of term insurance policies will expire, meaning they won't pay out, meaning 98% of the time the person doesn't die and their family, their beneficiary rather, does not get the payout. That's what we hope for, right? We don't want to be in the 2% that gets the $1 million life insurance policy. However, we don't know which bucket we'll fall in, and so it is never the 98% of people that don't need it that are the ones that are going to buy it. if that makes sense. They are oftentimes trying to do the math, thinking, I don't need life insurance, it's not going to happen. They just want to talk about how much money we can make them, right? Well, it doesn't matter how much money I can make you over the next 3 years, 5 years, 10 years. If you're in your 30s and your life expectancy is to your 80s and you make $100,000 a year, it doesn't matter how much money I can make you because your family is going to be missing out on, just to make it simple, your life expectancy times your earnings. That is what your family is missing out on. That's what you're insuring against. So it's not what's the word I should use? It's not a sexy conversation. It's an ugly one. People don't want to talk about their death. Mm-hmm. It's not something I bring up with my clients all the time, but they would be remiss and I wouldn't be doing my job right if I did not bring up insurance and protection products. So the role they play in financial planning, to answer your question succinctly, is critical. They are the bedrock of financial planning. We need to make sure in the worst case scenarios, something doesn't happen. And that is guaranteed with risk transfer products. Okay. Like umbrella liability, term insurance, disability insurance, you name it.
Tell me a little bit about your team and the Sharp Group, and also how'd you get into financial planning?
Yeah, that's a really great question. So I'll take them one at a time. My team, the Sharp Group, none of us are named Sharp. None of us are dressed that sharp. This is on film, right? Yeah, none of us are dressed that sharp. We are named after the Sharp ratio, which helps you find risk-adjusted returns. I can't beat a dead horse too many times about how we help our clients find where they are on the risk curve, how much risk they're willing to take, and find the best investments suited at that risk level. Now, this founder of my team, my group, was Lawrence Rubenstein. He goes by Larry. Going back 60 years at Oppenheimer, he was a market maker on the NASDAQ in the healthcare sector. So nowadays, he plays the role of our quote-unquote stock picker. He's our stock jockey, our asset allocator, the one who is behind the screens, actually making the portfolios day in and day out. My second business partner with him is Justin Gelbman. His background, he started at a bond shop 20 years ago. He handles most of the fixed income for the team. So what does that mean? Bonds. So Larry is stocks, Justin is bonds. Then you have myself that heads up the really estate planning and financial planning part of the team. What that is we just talked about the risk-off products. I handle all the estate planning conversations. I handle cash flow modeling, fancy words like that. I handle insurance, the safer guaranteed products, things like that. I'll help our clients structure. I'll work with wholesalers and partners. Then, of course, we have two other younger guys on the team that are similar to my age that help in relationship management. So all things that come across the desk, there's a couple hundred families that we work for. Anything they need, the relationship managers are there full time and will loop in either myself, Justin, or Larry, depending on what the conversation might need. And those guys are Michael and Matt. And so our team is based in New York, New Jersey, and I'm in Boca Raton, Florida. So we have one person that sits in all three offices at all times. I am the Boca Raton aspect of that. And Larry and Justin are snowbirds. So they spend half the year in New York or New Jersey, or they spend half the year down in Boca with me.
Like a lot of people.
Yeah, so we fly wherever we need to be for our clients, but really there's the five of us advisors, 2 support staff. The Sharp Group is 7 people total. We manage about $1.1 billion at Oppenheimer. We're about the second team by size at Oppenheimer, so very well respected within the group. And how I got introduced to the team, or how I got into financial planning, and this is also my background, why I'm kind of the planner on our team, is I started out at school at Massachusetts Mutual Life Insurance Company. It's a A-rated mutual company. We called it Mother Mutual. They gave us a PhD, an Ivy League degree in insurance. However, I did not love that every single conversation I went into was about insurance. Even if, Rich, that square peg didn't fit in that round hole. That was how I got compensated. It did not appeal to me. I didn't have the same fiduciary licenses and responsibilities that my team has now. It was a sales role, but it taught me a lot. And it was the first job out of college. From there, I went to Raymond James, where they taught me a little bit more asset management, how to really develop a client book of business, how to really be a financial advisor for a family, not just the insurance or protection guy. However, I found myself very siloed. Taking on all of those roles for all of my clients was stressful. And for the people watching this, I don't have too many gray hairs. Picking all the investments, everything falling to me, I feel as though there could have been upside I was missing. So when a recruiter from Oppenheimer came around and told me that one of their big teams was looking to expand their Florida presence with a new relationship manager, I thought it was perfect. I had met with Larry and Justin, my now partners. I met with the manager of the South Florida complex, an awesome guy by the name of Brian, who you've met once because I brought him to some of our networking groups. And it turned out to be a match made in heaven. I was able to take the relationships I already had from Raymond James and introduce them to the team, the new capabilities, the new partners that I had, and what else I would be able to bring to the table with them. And then consequentially with the team, what I was able to do, I had a very different upbringing, a very different experience than our bond expert, Justin, or our stock expert, Larry. I was able to add from an estate planning or more cash flow modeling perspective, some of the newer technologies, some of the different insurance products in the marketplace, and it's really just been gas on the fire since then. So we all have our roles, we all service all the relationships across the group, and we're much more selective now with who we work with because we know we're bringing a great product. So that's how I found them, and that's how I got into them, and that's how we work.
Interesting.
Yeah.
Now, from a lending standpoint, one of the things that I'm able to do is I'm able to lend in all 50 states. From a financial planning aspect, is there anything that prohibits you from going from representing somebody in different states?
No, I'm right now we're licensed in 48 of the 50 states. I don't want to tell you which two, but
We got to know.
I can go to just let you know if there's somebody in Hawaii listening to this. That would be great. I would really like that state. Like you, we are often trying to be a resource to our clients, so we're flying all over the place trying to meet people in person. But there's no restrictions to how we operate. We even have an international group. I have some clients with money in Canada, Mexico, UK, you name it.
Now, one of the things that from my standpoint that I compete with, like internet lenders and lenders that don't necessarily give you that direct service, and I'm sure that you have that as well. And I know that I'm trying to remember. There's a couple companies that I know of that do financial planning.
Sure.
That just have like each investor has thousands of clients.
Right.
Right. How many per team member? How many clients do you guys typically work with at a time in terms of managing their portfolio, so somebody knows that they're getting that personal attention?
That's a fantastic question. It's almost because there's like the Rocket Mortgages out there of the world, right? And yes. I would never send someone to the Rocket Mortgages, right? I have the Brandt lending team.
Right.
That makes sense. So yeah, you have the Fidelities and the Charles Schwabs out there of the world. They have their place in the market. Don't get me wrong. If they're smaller portfolios that will manage you for free and zero commissions and don't need too much handholding, don't need too much answers being many questions being asked. The guy at Fidelity, the guy at Charles Schwab is literally overseeing, and I interviewed there when I was bouncing around to Raymond James, they literally will oversee 300 to 500 million for each person. So 300 to 500 million of small accounts they could be 100,000, 150,000. That person will literally have somewhere between 1,500 to 3,000 names.
Wow.
And it is insane. Basically, that person's job when they come in is they have 50 emails from dozens of their accounts with one-off questions, and they'll just decide who they're going to get back to that day. They're on salary from Fidelity. They didn't build this book of business. They have no personal relationship with any of the clients. Who cares if it doesn't get serviced? There's a next guy in the call center to do it with. And again, at the lower ends of the market, at least these people are investing, because that's what I would say is there is a place for this in the market. That's better than someone just walking into their bank and buying a CD because they just don't know the difference for their long-term dollars. Investing, that's still investing. However, for more a white glove level of service, as you get to the higher end, as you're worried about the potential upside you're missing and, God forbid, the downside, how to take risk off the table as the numbers get bigger, my team works with about 300 families right now. We have about 2,000 accounts total across our 7 people or 5 advisors. So that would be, again, only 400 accounts to a person, roughly about 70 to 90 families each that we will each interact with. And they all have my cell phone. They all have my, they have 1 or 2 of them even have my mom's phone number for some weird reason because I've taken them to dinner when they're in town.
Right.
We build a much deeper, really holistic relationship. We try to be everything for a person.
Yeah, what a difference.
Exactly.
Now, earlier you said that Larry was a market maker.
Oh, yeah.
I didn't know what
is
that meant
right?
back in the healthcare.
Yeah,
right?
what does that
Yeah,
mean?
what
You're
is
right.
what is a market maker?
Yeah, great question. So nowadays you got computers doing everything. I've been to the New York Stock Exchange. I showed you that pic. It's quiet. Like you walk on the floor and there's like 3 guys working a bunch of terminals. Back in the day, buy, sell. You've seen the videos, the pictures,
Yeah.
well,
Wolf of Wall Street.
right. So up above that, so the Wolf was selling to retail, to individuals. Up above that, his firm, Stratton Oakmont, they have to actually have the stock to put in their clients' accounts. They go through institutions. They go in what's called the primary market. So just to make it super, super simple, Larry was working at Oppenheimer. He was connecting healthcare companies with people that wanted to buy, big stockbrokers like that wanted to buy on an institutional basis. So they were saying, we want 1 million shares of AbbVie. We want 1 million shares of XYZ Big Pharma because I am Merrill Lynch broker and I need these 1 million shares for my clients. So Larry that's what the expression was make a market. They had to go into the market and you had to see and you were making a cent on the share. It's worth $3.89. I'll give it to you for $3.93, and the firm makes a cent on the transaction, and the stock's yours. You can now give it to your clients.
But it's millions of stock.
Millions,
Wow.
block trades as they would call it. Big deal. So he would make a market, and his thing, since there's so many stocks and there's so many people buying, you would divide it up by sectors and you divide it up by companies. So Larry was in charge, or Larry at Oppenheimer. His relationships, he handled a few healthcare companies. And so when he switched decades later into the Sharp Group, into helping people as a financial advisor, no longer a stock trader, those were his first calls, were people in the healthcare sector that were already trusting of him as an authority. I have a question for you,
Sure.
Mr. Loan Doctor. I'm on CNBC all day, and they're saying right now, I think I'm reading 2 loan cuts. They're reading 2 interest rate cuts they're predicting before the end of the year.
Yeah.
How do you feel about them predicting that? And when clients come to you, are they saying, now maybe they're not the sophisticated ones, for example. Like I have people coming to me when I'm talking about bonds and they're saying, oh, rate cuts. That's the really sophisticated person. Is that ever coming up in your conversations? There's rate cuts. Should I
rate?
Like, the average person only buys a home once every 20. They're going to Google it and they're going to say, oh, rate cuts, right?
It's an interesting conversation just because I will say this, because I was telling this to somebody the other day and he literally told me that the way that I explained it was the best way that he's ever heard it.
Oh, I'd love to hear this.
So I'm definitely going to do that while I've got this opportunity. So what happens when the Fed cuts rates, they're actually cutting short-term rates. They're cutting short-term interest rates. That means that they're impacting like your credit cards, personal loans, auto loans, and things like that. Long-term rates are actually set more on speculation. So what ends up happening is part of the reason that rates have come down in the recent months was because the market has expected that the Fed was going to actually have 3 rate cuts before the end of the year.
Right. They're
And that's
pricing
what
that in.
drove the market down, exactly, pricing that in. And so that's kind of what happens. One of the things that also happens is when the Fed makes an announcement about rate cuts, immediately after, the inverse happens. Rates are actually going to tick up because the speculation is kind of set. Right?
Oh, because what was speculated is now written in stone.
Is now written in stone. So rates actually have a little bit of an uptick if they come down. And when rates go up, they actually have a bit of a downtick, which is something that happened a lot. I think that, and we speak about it all the time about timing the market, whether you're timing the real estate market or timing investment market. I get... one of my favorite questions that somebody asks me today is they're thinking about buying a house, they don't have a property, and they ask me what the rate is. I'm like, well, I don't know. I don't know what the rate's going to be when you actually go buy a property. And it would be kind of like me asking you, hey, I'm thinking about buying Apple. Tell me how much it's going to cost in December.
Right, right. I could give you a price target. It's more. Right. I mean,
Yeah.
But what's a great example of that? We never know for sure. We never know. I mean, I'll give you an example. Amazon has been flat for most of the year. Who doesn't want to buy Amazon? I mean, who
Sure.
doesn't want to own Amazon? It's been flat for most of the year. About 2 days ago, or it's wrapping up yesterday. I don't know if it affected you, but just this is a real headline. There was a Amazon Web Services and AWS outage. You heard about this? So Lyft was out.
Yep.
So you would think, oh my God, there's an outage. Maybe the stock might go down a bit, and it's been flat for the year. This is a bad sign. You know what Amazon did yesterday after that outage? It went up 1.5%, and it's up so far today. We're in the middle of the trading day,
Yeah.
and the only reason we can find is analysts are saying it's a positive consumer sentiment. What does that mean? People are realized how much of the internet runs on Amazon, so they thought that's a great thing. So let me go and buy more. I mean, you can never predict. Right? The only thing I build my portfolios in 1, 3, 5, 10-year predictions of market cycles. I like you just said, I can never tell you what Amazon or Apple's going to be in 6 months. So to quote somebody a rate, that must be frustrating.
Now, one of the things that I also do is I very much learned over the years that I stay in my lane, and I know what I do very, very well. And anytime I try to foray into an area that I don't do well, it doesn't particularly go well. So I was going to ask you a little bit about crypto. But before I kind of get your opinion on crypto that you brought up earlier, I'm going to give you my investment strategy story when it came to crypto. My brother-in-law, he used to host, he did website hosting, and he used to take Bitcoin as a form of payment. And this is going back,
Oh my God, how long ago?
15 years.
Oh my God.
So he said to me, do you think I should hold on to this when people would pay it? Because he would cash it out. Do you think I should hold on to it? Do you think it'll ever be worth anything? And my exact quote to him was, I can't believe it's worth $50. And so it didn't go well for me. But that's why I rely on people like you and stuff like that to help me in the areas that I'm not an expert at, which is hopefully some of our audience. So tell me, where are you on crypto right now, and as a sound investment?
Yeah, I like the word choice there. As a sound investment, I don't like it. I don't like it as a store of value. I do like it as a hedge. I do like it as an exposure to fear of missing out. I do personally have about 2% of my net worth. I even will tell clients about 1 to 2% of your net worth in cryptocurrencies. They will then ask me what cryptocurrencies. I will say, like you just said, I stay in my lane. I am not a crypto expert. I am not a crypto analyst. I own the biggest names. The biggest names would be Ethereum, Bitcoin, and Chainlink is one I also enjoy. But that's just because, like everyone else, I read what I read. I see what I see. I don't want to get left behind. So I will dollar cost average is a phrase, which means to just dip a little bit of money in over time. I'm not trying to time the market. I don't see Bitcoin dip down and buy more. My platform, Oppenheimer, does not sell it. I don't sell it to clients. However, I do, in a financial planning standpoint, I do say it is real. And the same way that a lot of my clients have gold in somewhere between 2% of their net worth, I'm now advising cryptocurrencies around 2% of net worth.
Okay.
Very different than the gold. The gold is a store of value. Right now, it's at an all-time high. You did make money on the gold, but traditionally, that's not necessarily what people are buying gold for, right? There's short-term dollars, there's long-term dollars, there's savings. Crypto is very speculative and is a hedge against the U.S. government continuing to degrade the dollar. That is what it is. And again, I go back to early on in this podcast, for however long we've been talking, I said people like to know what they own. You can flip that script on me. Maybe I don't know enough about it, so I'm not confident in putting more than that into it as well. So it could be a what would they call me? Like I don't know enough to know. I'm a boomer,
Yes.
right? In that respect, right? So that's my take on crypto. It is real. It is here to stay. Which will be the winners and in which capacity, I can't tell you. But the technology of blockchain, I've now seen instituted across. I mean, it's now, my healthcare provider is now on a blockchain, so it's here to stay.
Wow, that's interesting.
Yeah,
Okay.
it is. The technology is here to stay. In what capacity? I invest. I think in the same way. If you invest in Nvidia, those are the same chips that are used to mine cryptocurrency. In my head, I have some exposure to the cryptocurrency world in that respect. So as Bitcoin does better, some of those companies will do better as well. So there's a lot of different ways you can get exposure to it. Short answer is it's real. It's here to stay.
Speaking of NVIDIA, now how is AI starting to impact your business?
It has actually so far only made my job and my team more efficient. We are direct recipients of a productivity boost. And what do I mean by that? I don't just mean, we're using ChatGPT to spell check our emails. Sure. But it is actually, we have taken it a step further. We fed it all of our marketing materials, and we said, give us a why statement. We said, give us a mission statement. We said, give us roles. What is your perception when you read these marketing materials? We're like actually using it as a sounding board. We're using it as getting all this advice that we never would have thought. And then it gives you step by step. Now, of course, not everything is a good output, but it's a really cool starting point to revamp a lot of what we've been doing, a lot of our archaic systems. It is, I'm trying to think of a more concrete example that we've been using it in, because there have been a lot of good examples. But like Larry, for example, used to have to read a couple dozen research reports about companies that he liked or companies that he felt he was not in tune with in our portfolios. And now basically there's agents, AI agents, that are able to give him synopsis per company, so he doesn't have to read an entire 10Q or an entire quarterly filing or an entire annual report. So so far we've seen productivity gains. My team, we're probably looking to hire another person, another support staff, another teammate. So far, it has actually made it so that our two current teammates are able to support us.
Wow. Okay.
Yeah. How about you in your world?
So I discovered something not too long ago that I didn't realize, that when it comes to some of the technical aspects of the input, AI can actually be wrong, and it could give really, really bad advice if you're not paying attention to it. Which I thought was interesting, just because it really is just a collection of where it's getting its data from and stuff like that, and different AIs are going to have different responses.
Right.
So you're the kind of the same way. It does kind of help us with some customer service aspects of what we do. I haven't gotten to the point where I can rely on it for some of the technical things. One, because of a lack of confidence, and I've literally witnessed it get stuff wrong, very wrong.
Yeah, my brother, who's an attorney, it's very different than what we're saying. They it's like no, persona non grata to them.
Yeah, I was actually, and I hope this helps a lot of people, because for me, I was surprised to find out that the information that you get was wrong. That I almost thought that, when you
And was it basic, or was it something super advanced?
No, I mean it had to do with like mortgage terminology and stuff like that, and just qualifying specifically and what you're looking for, and it just spit out data that just wasn't correct. One of the things now that I've been doing as a tip for everybody is, when I ask AI a technical question, I want it to give me the resource. I want to see where it got the information, so I can decide if the information is right or not. And when I did that's kind of what helped me realize what was going on.
Telling it, cite your sources.
Yeah.
Like we did in grade school.
Exactly right.
Cite your sources.
Exactly right.
Another one this is a one-off, but it just came to me. There's this AI tool I use called Script, SCRIPT, Script.
Okay.
Yep. And you basically record yourself doing a tutorial one time, and it will the AI will create a video with visuals. It'll chop it up. It'll take your overview, and it will make like a real tutorial. All you have to, it's so much better than like I was recording processes like just recording my screen over Zoom where I was retraining a person on something every couple of months. And now I just have a library of these really well-made AI videos where I just had to talk to the AI and show it, and the AI made a tutorial video. And I have a library of
Oh, that's
AI-made
amazing.
tutorial videos that I'm driving it, but now I can just point to this directory. If I were to hire a new person too that I just talked about, that's in preparation. We can just run them through our modules.
Let me ask you this. So a lot of times, I have a client. We just closed. They bought either their first house or second house, whatever it is, and now I've got to get them. I want them to start thinking about insurance and thinking about financial planning and thinking about they've done this real estate investment, and that's kind of step one. Now, get them to that next thing. What would you say is when somebody buys a house, what's the first thing they should do when they're ready to start going through that financial plan?
The first step once they've bought a home would probably be when we start a financial plan, the first thing I'm probably going to walk them through and tell them to do, probably not to beat a dead horse, would go back and would probably be term insurance. Now that they've taken on a mortgage more than likely, and they've
Right.
taken on this new debt and they've collateralized it and the family will be responsible for it even if you're not around. That is 9 times out of 10, as soon as you've added new debt to the books, we want to plan for that worst case scenario, how to provide for the debt.
Can you get a term policy that's 30 years that mimics the mortgage?
You can. Term policies, it'll vary insurance company to insurance company, but the standards are a 10-year, a 20-year, a 30-year.
How does the term policy differentiate from, we have like a mortgage insurance that would sort of protect you in the event of job loss or something like that would pay off the mortgage. Generally, as a rule, I don't really love it, mostly because what ends up happening is the value of the policy decreases over time. As you pay down the mortgage, the benefit that you get is a lot less.
Right, and you're still paying the same
And you're
premium?
still paying the same premium. So I'm just wondering how the term policy kind of fits in line with that.
Yeah, really great question. Term policies are super simple contracts in the sense that it is use it or lose it. You make an agreement with the insurance company. Let's take a 30-year agreement. They promise to pay you $1 million at any point over those 30 years if you were to pass. There are rules. Usually there's a 2-year suicide clause, for example. And the differences between what you just named is that $1 million is stable. It will not decrease or increase in value. And your premium is going to be what's called level. You're going to be paying the same monthly or annual dollar value for the entire 10, 20, or 30 years of the term. So difference between that and the mortgage protection is as you continue to accumulate equity and pay down the mortgage, and so the benefit is decreasing, the premium is staying the same. With a term insurance product, premium stays the same, benefit stays the same, and you can also use the funds for whatever you choose. What if you decide not to live in the home and you sell it? What if you decide, mom is going to pay it off for you after that time of need? There could be many reasons. I'm assuming the mortgage insurance would not pay out in any scenario, but to cover a mortgage.
Correct. Typically that's how it worked. Now, the one benefit is it wouldn't make the payment if you lost your job or something like that.
Right.
So there are a couple
And term
of
insurance does
side
not do
benefits.
that. Yeah.
But there are other insurance vehicles that would, like key man insurance and things like that, that somebody could get.
Correct. You can plan for pretty much any event. So there's disability insurance if you were to be sick or injured, unable to work. It's basically income replacement. There's even provisions you can put on these insurance policies, very, very similar to what you just talked about with the mortgage protection. And these are called waivers or waiver of premium. If you were to be sick or injured or disabled, they will pay the premiums for you. And or the insurance company will agree to take on the premiums, and you'll still keep the policy in force. So you can plan for any event. You just need to start the dialogue, really.
Okay.
What keeps you up at night, as they say, and then we can work to remedy that.
I think one of the things that happens in any job, there are interesting stories that happen, and they vary and stuff like that depending on the job. And I often say that I used to own a process service company.
Oh God,
That guy knocks on your door, says, "Hey, these papers are for you," right?
you've been served.
So my stories at the time were way cooler than like what my mortgage related stories might be. But in asking you, tell me a story.
I want to hear a really cool process serving story.
I could tell you some really good process serving stories. We can get on that. I guess I could talk about one.
If we have time.
Since we brought it up, we could talk about
It's your show.
Definitely brought a process serving story. So I will tell you my best processing service story is that I was late to my wedding.
Your own wedding.
My own wedding, I was late to my own wedding. And the reason I was late to my wedding is because we were serving somebody that was avoiding service. We knew he was avoiding service. He was running around like a chicken, didn't want to be served and was doing everything he could. So on the day of my wedding, we got a tip of where he was going to be. And when the tip came in, I needed to have 2 process servers to be able to go serve this guy because we knew that he was going to run. Right, that was the whole idea, is that you have one guy at the front, one guy at the back. When the guy runs, everything is good, right? And we're talking in the early 90s.
What if there's a third way out?
Late 90s. Well, if there's a third way out, we didn't think about it. So we get to where he is. The guy sees me. He runs, right? My other servers there are taking pictures and everything like that. The phones weren't quite the same as what they are today.
Oh my God.
But anyway, we served him. Everything was good. Fast forward 5 years later, 6 years later, we're watching the previews to this new movie that's coming out. I don't know if you remember the movie War Dogs.
Yeah, Jonah Hill.
Jonah Hill, right, exactly right. So the movie War Dogs was about this guy who was selling ammunition, was selling military weapons to the U.S. government, but acquiring them illegally and all that kind of stuff. Well, the character who the movie was based on was who I was serving.
Oh my God.
Which is so.
Are you allowed to say what you were serving him for?
No, I'm not going to. At least not in this. But he wasn't a good guy.
Oh my God.
That's
an incredible story.
It's pretty unusual. So
good movie.
It's kind of cool. It was a good movie. But I remember reading about the story, and I go, wait a second. I know this person. I know this situation.
That's crazy.
And that was.
I don't have any story that could beat that.
Okay.
If that's your next question.
But tell me, do you have any clients that kind of stand out, or something that stand out that you found humorous, or not even just really kind of interesting that you didn't know?
Yeah, I've had some unique ones.
Right.
Actually, one was funny. This isn't even a funny story. I have a guy that lives on a boat, and so his address is the local marina.
Okay.
You can do whatever you want. He's retired. It's his money. He lives on a boat. But how do you send their statements to the person? And there's also maritime laws. If you're out at sea for like over 300 days, you're technically not like a U.S. person. I'm not saying that exactly right, but that's what we had to deal with. Is if he's out to sea too many days, we couldn't send him the statements. The marina, it was bouncing back. They don't have a P.O. box. How do you we had to drive out to the marina. It wasn't too far. It was like almost Coral Gables, though. Like, I had to go down to Miami, and we had to find him because he was answering his phone, but basically the post office was returning it as non-deliverable. The firm had gotten so many non-deliverables that they considered it an invalid address. And they say, we need to basically get confirmation, or you can't open an account in his name. We can't send him a 1099. You can't receive compensation on the accounts. You can't ... So once it got that serious, we drove and we had to find where he kept his boat. And we had to explain that this is not a suitable address and that you needed to give us somewhere else so that we can start sending you statements again.
Okay.
So he lived on a boat. Yeah. Not that funny. But
no, hey, that's okay. I guess he's never heard of a P.O. box.
No, he was sending him to the marina. Yeah.
Oh, that's funny. That is interesting.
Yeah. I have some elderly clients that don't believe in email. Don't have it? No, they don't believe in it. They have gotten maybe so many scams, or they are just so anti-technology that I actually have to go back to my firm. And, maybe 8, 10, 12 years ago, they migrated certain processes to DocuSign, or they did DocuSign only or electronic transfers, and I have to like literally open up closed processes so that I can do business via a direct transfer and wet sign and wet paper, anything for my clients.
Right? No, I'm the same way. Absolutely.
You have any funny mortgage stories?
I have a couple of good mortgage stories. I think I told one. It depends. There's a couple of things that it kind of depends on because there are funny, good stories. There are sweet stories that I talked about. I had a client who wasn't.
I avoided the horror stories.
Yeah. Well, I had a client that wasn't mortgage ready when we started, and we got him mortgage ready. And as we went through as we went through the program, his father actually ended up passing away.
Oh, that's horrible.
And so, but he kind of stayed with it. And so we dealt with not only him, but having that kind of change in his circumstance and still getting him to the promised land where he was able to buy a house.
Oh, great.
And go from being a home buyer to a homeowner. And so there's a lot of rewards for that. And then I had I had a lady, I will say this because I just found this funny. I had a woman that reached out to me that was looking to buy her first home. She didn't have any money to put down. She didn't have any money. She didn't have any savings in the bank or anything like that. And her credit score was like 450, right? Who's giving this lady money? It's a really bad situation, and she's got to get that situation straightened out,
Yeah.
right? But I reasoned the fact that she had new lines of credit and something must be going on. In her mind, I know that she's thinking these people who are giving me money must be giving me money. Because who'd be stupid enough to lend me money? Because there's no way they're getting paid back.
Right.
And so I just kind of found it anecdotal that she was looking for money. And one of the things that I say about credit is a measure of your willingness to pay somebody back. It's not a measure of your ability. Cash flow is a measure of ability. Right?
Yeah.
And so a lot of times you might have somebody like a doctor or not a loan doctor, but a different doctor that generates just a ton of income and yet their credit is poor. And it's just because they don't value the importance of meeting their obligations. And so that makes a difference when it comes to lending.
So they're missing credit card statements. They're missing they just did things over time to lower their credit score.
I had somebody tell me. I literally had somebody tell me I just can't. It's $100 bill. I just can't bother to be bothered with mailing him a check.
Yeah.
And
It's
stuff
been
like
a drag
that.
on their credit for years.
And so that kind of happens. And one thing that I will say from a bank's perspective, a bank will forgive an interruption in ability before they forgive something an interruption in willingness. If people just don't care about their credit or don't care about living up to the obligations that they kind of set for themselves, the bank doesn't have a lot of tolerance. But if somebody like lost a job and their credit took a hit because they lost their job, that's something that is a little bit more forgivable.
Oh, fascinating.
Do you have situations where, like, what happens when you have somebody who says they're going to put in X number of dollars, over a certain time, and they have to pivot from that? What happens in those situations?
Yeah, we like to say that when I put together a financial plan, it's a living, breathing document. Things are always going to be changing. I will put together a financial plan that shows 25 years from now, you have an 87% chance of success. You know how much can happen? You know how much can happen over the next 25 years.
Yeah.
These are averages, and we do our best, and that happens more often than not. Rich, actually, I don't have a single plan that we put in place, and then when you get to the end of it, it was exactly as we planned. It's more often than not something's going to change. We need braces, add that in. Hebrew school, bar mitzvah. I got laid off. The company got acquired. AI, you name it. So it's no big deal, and it's a relatively easy fix. We then take where you are from that point in time, and we reframe and refactor with these new data points.
Right.
And we work to achieve your goals. It's all about your wants, your wishes, your needs, and the financial plan. Money is just a tool, really. I tell my clients money is just a tool, and again, going back to the ones that don't tell me they're buying a house until it's too late. Money's just a tool. Allow me to help structure it to help you achieve your goals. You want to leverage it in the best way possible. The wealthy leverage their balance sheet to the best of their abilities. Now, in terms of a financial plan, changes all the time. Just keep me up to date. And you don't want to come in for your annual meeting or your quarterly meeting and say, I'm sorry, I have been blowing you off for the last 2 years. because I have people like that. They say they're all in. I gave them a financial plan. These are the steps I need to work with you on. And then you don't hear from them for a few years. And then they check back in about how they're going to achieve the plan. Well, I don't know. We haven't been working on X, Y, and Z. All you did was we put together this great projection, and then you didn't actually work with me on any of the implementation. So I also get that too. People come in and they say, I need to change the financial plan. I say, great. You didn't do any of the things I said initially, so no harm, no foul.
We do. It's funny because we put together sometimes for people who aren't ready, who aren't necessarily mortgage ready. We put together a mortgage roadmap.
Oh, great.
With benchmarks and things that they have to accomplish to make sure that they stay on track. Right.
What are some of the things that you help them with to get there? What's that roadmap? That's fascinating to me too.
Well, so I think it really is. It's a lot of times it's credit or income.
Right.
So you have somebody who comes to us and they're either not ready credit-wise, they're not ready down payment-wise, they're not ready with stability of income-wise. And so what we do is we just kind of set up their roadmap that says, okay, maybe we're not able to do it today. We're able to do it in 9 months and 12 months and 18 months, whatever it happens to be. And then here are the benchmarks we want to make sure happens at these different times. And then what we're going to do is we're going to follow up, kind of like your mortgage personal trainer. And we're going to follow up and say, hey, how are we doing on these benchmarks?
Wow.
And we're either, sometimes we have somebody who says, hey, you know what, buying a home isn't a priority anymore. And that happens, but most of the time, you have people who are doing well. And then even though we set up the mortgage roadmap, kind of like what you said, is things happen, life happens, and you have to pivot, either extend the time, shorten the time, change this or change that. It's all part of the normal process. Last question before we go is equity. So when with real estate, one of the things that's happened, in this country is a lot of people have equity in real estate. Mm-hmm. And where are you in terms of using that equity to leverage that to some of the things that are going on with the economy and other sectors? Is there ever if somebody's got, let's say, I know you don't want to have all your eggs in one basket and stuff like that, but if you have, let's say, 30% equity in your home, would one of the strategies be, well, let's take 20% out and use that 20% in a better sector where we can get a better return?
That's a really great question, and like with all things financial planning, there's definitely nuances to it. A huge part of that is if they're currently still holding debt or mortgage on the home, what is that rate? Because I don't have to tell you, for a long time, a decade, interest rates were near zero. I have some clients who come in and their interest rate is 2.75 on a 30-year note, yeah. And the advice,
don't ever prepay.
Is pay is right. I mean, they are lending you that money at a great rate. That is, and I can use a fancy word, arbitrage in the simplest terms. If I can make you, I don't even have to, let's not even get fancy with it. A money market can get you 4%. They're loaning you money for 2.75%. You can make 1.25%. I don't think that's too many numbers for a podcast, right?
Somebody else's right. I'd borrow
somebody else's money.
Somebody give it to me.
Say that again, right? Other people's money. I would borrow $100 million if someone would give it to me at that rate. So huge. That's like number one. Like, where are we with that? Also, the rest of the balance sheet. I don't want to, going back to, you asked me a great question before about the home, real estate on the balance sheet. It's the same answer. I don't want to upset the natural order of things. I am never going to tell you to take equity out of your home to increase your stock portfolio if that is going to mean that your home is less than 20% of your net worth in that scenario. I don't think the arbitrage is ever going to be worth it in the worst case scenario, believe it or not. There are tools to leverage. There are things that make sense. I'm sure you work with your clients all the time. I think using home equity or building out a HELOC to buy your next property, I think makes a lot of sense. But with something that is so unpredictable as the stock market, it is not something I'm doing often. It is more so like nowadays, it's not happening too much. It is really those people that are close to retirement that have a mortgage at 4 or lower. and we're able to use the equity for a sense of arbitrage. It's not happening a lot with, I'll give you a different way to look at it. My parents bought a home outside New York City in a no-name town for, I'll make up a number, but this is still very real numbers, very real example. They bought it for 300 grand. They'll probably sell it. They're looking to sell it right now for $1 million. And it's not like they doubled the size of the house or 3x the size of the house. It's not like it's 3 times the square footage. It's not like it's 3 times. It's just the nature of the marketplace over the last 25 years. My generation is going to buy that home from them for $1 million. I do not believe it will be worth $2 million 25 years from now. So what do I mean by that? I don't think my generation will create wealth in equity the same way that my parents' a previous generation has, because I don't think I have to tell you where the housing market is right now. Of course, it can go up, and it will go up, but trees don't grow to the skies. And I don't think a home in Boca Raton in 30 years, the starting price is going to be $5 million. It just isn't obtainable. It's just so that is my take on home equity.
Well, Noah Wills from the Sharp Group. I appreciate you being here with us on the Loan Doctor podcast. And I want to thank you guys for tuning in. And I appreciate you being in my waiting room.
All right. Thanks for having me, Rich.